Sheryl is, she's not a medical doctor, but she's a Ph.D., which makes her a doctor. She is forever innovative, fresh ideas, moving with the space, understanding what's going on in capital markets. Sheryl's been around long enough, at the same time I've been around, to know analysts could actually talk to investment bankers back then. She's an awesome supporter of the UCI Center for Healthcare Management and Policy, speaks here every year, and could be a keynote anywhere. Join me in welcoming Sheryl.
Well, thank you very much for that. I have to agree that Watson must be a she, so let's give her the right first name. And I thank you for that comparison, but I fear that I won't live up to it. I would be remiss if I didn't extend, since I am your wrap-up speaker, a great thank you to Paul and to Margaret for once again treating us to probably the best healthcare conference all year long. Thank you, Paul and Margaret. Also, on a personal note, many of you have seen my older son grow up, and some of you have asked where he is this year, so I thought I'd make the public service announcement that Alex is fine. Thank you very much. He has finished his first semester of senior year in high school, gotten through those grades and midterm exams, and is taking a well-earned rest. I expect to wake him up when I get home early Saturday morning. Be prepared perhaps next year for the next generation of the Skolnick Dashman clam to start dinging the bell for all of you to come in. Our little son is about ready to be old enough to come along with Mom to the Healthcare Forecast Conference, and we'll start another generation in this wonderful and warm family. And so I thank you for that. I think all of you have probably seen my presentation already. It's out there, and I have to, unfortunately, prepare it a long time ahead of time before I get here. Not because of Margaret so much, but because I have a compliance process I need to go through, and as co-head of research, I got to be, little Miss Super Compliance here. That means that I have pages of disclaimers, and I can't really change it on the fly, at least not in writing. But I think what I'm going to do is I'm just going to go through the first couple of slides, then leave it on sort of the last slide, because most of you know what I'm going to say, and I'm going to change it up, and I'm going to say something completely different. So we are, in case you haven't figured it out, in the period of starvation in the land of plenty, lots of old people and soon-to-be newly insured uninsured people, and no money to pay for them. I first started talking about that back in 2005. Every year I come back and pretty much say the same things because guess what? Not that much really has changed yet. We're on the cusp of tremendous change. So let's look backwards a little bit and then we'll go forward. First of all, a quick summary of the year. We had SCOTUS, Supreme Court decision. We had the election. We had reform. We had the cliff. We had the Medicaid surprise coming out of SCOTUS, which, tossed everybody, as was mentioned yesterday, was the one thing that we didn't quite get the message on from the conversation we had about it last year. And then, of course, we had the dance at the end of the year where they wake up on the last day of the year and say, oh, gee, maybe we better do something in Washington to avert a fiscal crisis that could send the world into worldwide recession, if not depression again. This sort of dance on Wall Street actually you would have thought that Wall Street might actually have reacted positively to the settlement of all of those fiscal cliff issues, even if it was a kick the can down the road. And in fact, it was a blip. The market didn't even react. There was no celebratory rise in the equity market. There wasn't any kind of reaction in the debt markets. We're just all immune, we're sort of numb. We're so tired of the partisanship. Actually, I'm tired of the partisanship in the way people invest, but I'll get to that in a second. We're so tired of it that we no longer have confidence in our leaders, and it's one of the reasons why I think, the retail investors are not coming back into the market and not giving us back the bull market runs that we've had and experienced in the past. Washington, unfortunately, contributes very strongly to the fact that my business remains in a recession, if not in an absolute depression. One of the things I focused on last year was Optum. I learned about it through the coincidence of events through my friends at Memorial Care. and went home and started badgering United about what on earth are you doing buying up physician practices that are capitated, no less, in Southern California, considering that capitation was an anathema under Bill McGuire, and now they're embracing it wholeheartedly. What is going on here? What did you drink last night? And the answer was Optum. And the answer was a very different United Health Group, but one that they actually kept out under wraps. Well, during this past year, and started at the end of the year before, but in this past year, Optum has been revealed. You saw part of it today. It looks a little scary. It still looks a little domineering. It still looks a little dictating. But I have to tell you that for this enterprise at United, it is transformative. It is the wave of the future, and it's not as bad as it looks. So just give them a break and take a few minutes to think about what exactly it is that they're doing, which, by the way, is fundamentally, absolutely, permanently fixing the broken healthcare system one transaction at a time. Thank you very much. And they continue to do that. But we also had some big health plan issues during the year. We had some utilization surprises. One of the things a health plan really needs to do well is be able to predict, using its actuarial models and its actual claims experience, when cost trends are rising. They don't really have to do anything else well if they get the underwriting and actuarial predictions right. That's a message for WellPoint, because they don't. But having said that, United got it right. So as far as I'm concerned, they can pretty much do anything else they want to do with their capital that sounds like all of these very non-traditional health insurance company activities, like buying up capitated practices and like investing in those technologies and services and activities that actually change the healthcare system. They can do anything they want because they get the health plan right from an investor perspective. Then this year we had a lot of entertainment, at least from my perspective. We had the CBS Eye on fraud and 60 Minutes focus on health management associates. There's a lot to that story. Did anybody here in the audience see it? Okay. Did anyone who saw it come away with a positive impression of health management associates? Okay. I will paraphrase the informal survey that I did. Basically, the allegations, in case you missed it, which most of you did, which is not good for my friends who work at 60 Minutes, but okay. One of the things that they alleged was that basically physicians have been pressured, both with threat of financial repercussions and loss of job, to admit more patients, and especially to admit more patients over the age of 65. If you're 65 and you rolled into their emergency room, there was an allegation of strong pressure or else to admit that patient. In addition, they alluded to this, but the other issue here is that there's an allegation that they ordered, through the use of one of their information systems, unnecessary tests. So a 5-year-old who chokes on a mushroom has a full drug abuse panel ordered. Okay? So these were some pretty serious allegations that were made both on and off camera. And the company's argument was that there was no data to support it. Well, I beg to differ. I did a thorough analysis of the Medicare data that they submitted on cost reports and claims, and indeed find support for very robust statistical analysis, find support that there was, in fact, statistical differences between them and their local hospital peers in observation care, too few observations, too many short stays, and too high admissions. And oh, by the way, an increase in profits for the same period. They've gotten away with murder. The stock market doesn't believe me. They believe instead one of their investors in the company, who then points to the stock price of being up, is saying she's wrong. Sorry, that's a little bit of a round robin. But the bottom line here is we live in healthcare in an extremely contentious environment vis-a-vis healthcare fraud investigation. The provider is being squeezed in every different direction. It is almost impossible to take an action without fear of reprisal from a set of rules under the ACA that make it much easier for people to become whistleblowers. This is the new world of healthcare fraud and healthcare fraud enforcement. And the DOJ, by the way, pretty much has all the money they need for this, because it's the only bipartisan agreement in Congress that we should get rid of healthcare fraud. The shock in my world is that there's been a lack of M&A frenzy, with the market prices at the beginning of the year having dropped pretty significantly. Everybody worried about reform, everybody worried about the deficit, everybody worried about the election. You know, we love to climb that wall of worry. We've worn out our climbing gear multiple times this year. The lack of it was really quite shocking given the valuations, and more than that, given the fact that interest rates are basically zero. You know, if I could renegotiate my house loan at just over 3.5% for 30-year money, you can imagine that these companies who are AAA-rated companies are borrowing near zero. But they don't have an appetite for more debt, which tells you that they don't have confidence in the government's persistency and consistency with respect to its approach on regulation. They don't have confidence that there's enough visibility and transparency in the future under reform to be able to invest. And quite frankly, some of the companies that are out there aren't lending very much confidence to the private investment community to go ahead and fund some of these transactions. Nevertheless, we had some very significant ones this year. DaVita went from, with all due respect to DaVita, being sort of the bump on the end of the nose of the gnat at the end of the elephant's tail, being an end-stage renal disease dialysis company, to being front and center in the middle of the conversation by buying healthcare partners. If they wanted to make themselves any more relevant, they could have tried to buy United and maybe WellPoint and maybe HCA all at once. They really did a tremendous job of bringing themselves right into the center of the conversation around reform. Aetna, on the other hand, went out and bought Coventry. I'm still trying to figure out exactly what they gained there. If anybody knows the answer, please let me know. Sun Health Group first got rid of all of its real estate, making itself devalued, I thought, but then someone else who doesn't own any real estate decided that they were going to come buy it. The old Genesis Health Ventures, a privately held company, took Sun Health Group private. So that was pretty much it. Except that WellPoint bought Amerigroup and made itself, and finally decided maybe they were going to fix the problems that they've had historically in getting Medicaid right, because they still don't know how to underwrite a population or manage their health care costs. Sorry. I picked on HMA a lot, so it's okay, you know. They also bought 1-800-CONTACTS. Now, I was a WellPoint member at the time, and honestly, I was so angry at the board for allowing the then CEO to go forward with this. I'm also a contact lens wearer. I decided to stop buying from 1-800-CONTACTS because it made no sense at all. Okay, what is the synergy here? Don't answer. It's okay. I really don't expect you to. There you go. It gives you insight. It gives you a better vision for the future. That's the answer. Okay. Good. Amerigroup made sense. They got a great management team. Jim Carlson is very well respected as a Medicaid managed care guy from Amerigroup. He didn't get it right every single quarter. Actually came out of the United infrastructure once upon a time. So, you know, these folks sort of make the rounds. But where are we going with all of this? So the expectation was, as the market was very dissatisfied with Ms. Angela Braly's leadership, you know, it's never a good idea to take on the White House and then screw up in California. You know, with pricing, it's never, you know, the reputational issues were big ones. But more importantly, big shareholders really don't like it when you don't get the cost trend right and when you don't create value for them, the stock price does nothing. Okay, that's the job of the CEO and the board, is to look out for shareholder value, whether anybody else likes it or not. That's their fiduciary responsibility. That's what they must do. And in this case, both failed. What was shocking about that whole situation where Ms. Braly actually, her tenure ended in August, was how quickly after the second quarter earnings were reported that the board finally got the message and took action. And the expectation was pretty much that Jim Carlson sold his company, sort of the last straw. WellPoint wasn't bidding against anybody else to buy Amerigroup, yet somehow Carlson got them to raise their bid. So if I'm looking at a choice of who do I want protecting my money, it's not going to be Ms. Braly. It's going to be Jim Carlson, because he obviously did a better job for his shareholders than she did for hers. And so she's no longer the CEO. The board moved pretty quickly. It only took them 2 weeks of meetings day after day with investors to understand what we on the street understood in about 5 minutes. Congratulations to them. And they endeavored in the year before, in a year and a half before it reformed, they endeavored to go out and find a new CEO who was going to reposition the company, was going to fix the company, was going to do all this. You know, the timing was tight. You really, as a plan or as a hospital or anyone, one of the key issues that I have here is management. Is management ready? Is management skilled? Does management even know what skills they're going to need in the future? And the answer to that is, of course, no. None of us do. But what's going to happen with the management? Anyway, long story short, they finally, in the last couple of weeks, made their decision, which I would argue is probably 2 months too late. Was it Jim Carlson, the heir apparent? No. Was it Ron Williams, who, along with Jack Rowe, turned around Aetna when they had problems? No. Was it David Snow, who used to run the Oxford plans and then ended up at Medco and was sort of looking for a job? No. It was an extraordinarily talented, from what I understand, very charismatic and energetic leader by the name of Joe Swedish, who comes out of the not-for-profit hospital sector. Forgive me. You weren't involved in the decision-making, were you? Because if you were, I won't say what I'm thinking. What on earth was going through their tiny little minds? So my point is this, that I understand, and this is where I think they get it right. And you heard this actually from Dr. Nussbaum's presentation, and this speaks to the rest of my presentation. I've said this to you before. In healthcare, we have no time left for health plans and hospitals to be at each other's throats. There's no time, there's no money, get through it. Reform is real, it's here. The incentives have to change, the transactions must change, the context must change, the contracts must change. Stop clinging to the past. The past is broken, it will not work. So having this joining at the top of an organization may make sense, but not for WellPoint. Because WellPoint doesn't get the basic building blocks, in my opinion, of managed care right, which is predicting your claims and pricing for them accurately. When they can get that right, then they can go be visionaries. Until they can get that right, the street's not going to give them credit for it, and we should all be a bit concerned about their ability to drive consistent results and thereby pay for, enact, and get credit for all of the other wonderful, interesting, and dynamic and innovative things that they truly are doing. So that's my speech on WellPoint. As far as the deficit, I have 3 to 5 minutes. I haven't even gotten started yet. So between here and reform, 3 to 5 minutes. Yeah, you're gonna be here 5 minutes. Setting the stage between here and reform is this. Now, I've been using that slide for the last, 6 to 9 months. We've maybe gotten a little closer to the edge, but we still haven't built the bridge. So yes, we have essential benefits, and yes, we know how many states are going to be in the exchange, and yes, Florida's governor said, yeah, now that you gave me my waiver and I have a good face-saving excuse, yeah, okay, I'll be in the Medicaid expansion for 3 years, and now the House is balking at it. But there have been a lot of things that are still absolute unknowns. We don't know provider pricing. We don't know the structure of networks. We don't know the structure of contracts. There are still rules that need to be written. There are still state-based details that need to be communicated and worked out. And the most important thing from a health plan perspective, we still need to know who exactly it is we're insuring. Because that's the big risk. There's no data in large part about these insured or to be insured at the health plan. They think they're going to look like Medicaid. They don't actually look like Medicaid. Maybe they look like some sort of blend between Medicaid and commercial because some of them are actually working and some of them might have had insurance. But the point is the hospitals know exactly who these people are. They show up in the emergency every other week. So maybe one of the conversations that WellPoint can now have with itself is how do they partner with the hospitals? And United should be having that conversation, and Aetna and every other one to get that data so they underwrite it right and get the exchange correct the first time. The big risk that I see is that first, you're not going to have a lot of managed care participation in all the exchanges you want it because the economics aren't there for them. Despite the fact that premiums are going to go up, those premium increases are going to go to pay the tax. They're going to pay for the expansion of benefits. They're going to go to pay for the minimum MLR. They're going to go to pay for the fact that the plans are basically constrained in what they can offer, how they can offer it, and the fact that it's guaranteed issue to cover the adverse selection. So they're expecting that they're going to pay at least 85%, and in some cases, they're going to be in a loss situation and not participate in these exchanges. So, you know, the fact that the administration bent over backwards to create flexibility for the state didn't really change anything about the benefit structure because they're using the small group and individual policies that already exist as benchmarks. How is this reforming anything? So, having gone through all of that, this is a very, very tenuous time for all of these providers. It's a very tenuous time for the managed care companies. They need to start sharing the data. The hospitals have it, the health plans need it, so that they can pay the hospitals and the doctors appropriately. So that's one of the other things that's going on here. I need to comment on a couple of things. Medicare Advantage rates. Some people were confused by my question yesterday. How do I get to the minus 8%? Let me just walk you through that. The rule that came out, which was the proposed benchmark rule, effectively takes the coding creep, another cut, as well as the prior year, we'll call it positive prior period development, but an adjustment for the fact that Medicare paid less in prior years, and takes all of that together with the current year benchmark calculation based on current year Medicare fee-for-service spending, and essentially, based on those three components, comes up with a minus 5.5%. Okay, it's additive. It's 2.3% on the trend, plus it's 2%, plus it's 1.5%. So when you add it all up together, it comes up with minus 5.5%. Then, if you're a business thinking about entering a Medicare Advantage market, you also have to pay roughly a 2.5% tax. These are United's numbers. So when you look at 5.5% and 2.5%, you come up with an 8% cut. That says if I'm going to invest my capital in a market, I need to be able to do it at a price because I'm a price taker. I can't negotiate with the government. I can't pass along that tax to the beneficiary. And I, by the way, only have a little bit of wiggle room on how I change benefits. My choice is play at an 8% cut, invest the capital, or exit the market. The big difference between BBA 97 and what CMS just did to the health plans with the endorsement of Congress and the government and the administration is that the health plans have lived through this before. They've been there. They've done that. They're not going to take the risk that they're going to lose money. If there's a rising cost trend in any of these markets, the Medicare Advantage plans are leaving. And if they're not leaving, then what they're going to do is basically take away your favorite doctor from being in the network because your favorite doctor is probably the one who gives you lots of care, and that's not going to fly in the new environment. Okay, so that's what I meant by it. My message to my sort of more conservative-leaning friends about reform is please take the partisanship dialogue out of the equation when discussing the issues with reform. Those reform issues that you bring up, and as an example, you know, the very interesting discussion about what's going to be the impact on wages, and that. The discussion about how are we really going to implement this so that it works. It's the law of the land. If it doesn't work, it's really a problem for a lot of people, okay? So let's get over it. It's there. It's going to be implemented. It's probably going to not be a smooth sailing enough to begin with. And the partisanship is really rather difficult to stomach from this perspective because we can no longer trust what people are saying. And that filters over into Wall Street. So as an example of that, what ends up happening is that when the Supreme Court decision came down, the reaction in the market was less economic and financial and more political. Going into the SCOTUS decision, I could tell you what the political leanings were of every one of my clients. That's how infused the market is with the partisanship with Congress. You really want to invest on the basis of whether or not the guy is a Republican or Democrat? Because if you were a Republican and you were betting Romney, guess what? You were wrong. That's other people's money you're betting with. Never mind the health of the nation. That's other people's money you're betting with. So this is very dangerous. So you're seeing elements of the partisanship here. The other thing that I want to mention here, as we go forward, there's so much that we learned. As we go forward and we consider various forms of payment policy, and specifically with respect to Medicare and the difference between Medicare Advantage and Medicare fee-for-service. That example I gave yesterday on home health is a very real and real-time example of how the fee-for-service system is overpaying, how the incentives in the fee-for-service system need to be addressed. There's a lot that can be done. I'm not an advocate of taking fee-for-service away, nor am I an advocate for necessarily giving anyone over to private pay. My job is to sort of be in the middle and criticize everybody. So, okay, and I may be particularly well suited to it. But the bottom line here is that if we're going to have a Medicare system, for God's sake, stop creating these incentives for people who can't resist committing fraud to commit fraud. And home health care and hospice are two of the areas where that actually happens. So let's just talk for a minute about what's going to happen on these exchanges and what do we need to know and what is the stock market worried about. First of all, we do not know provider pricing. Those negotiations are beginning to happen today. If you are a hospital, sometimes the plans will tell you that they're going to pay you Medicaid, and sometimes the plans will say, well, we're going to pay something less than commercial or less, which, by the way, is every rate they have in the market, which is what United said on its last conference call. And the market said, oh, they're going to pay commercials. No, that's not what they said. They said, we could pay anything we want. Those decisions are going to be very interesting to watch, not only because they're going to have major ramifications for hospitals, but also, and health plans, but also because it's going to be very interesting to see which of the large publicly traded hospital companies play in that let's discount for volume game. And that's what I'm really focused on. As I look at a company like HCA, I'm sitting there saying, you know, not only have they been there, done that, it didn't have a happy ending, but what, you know, back in the 90s, which, yes, I was alive and watching them back then and recommending them, or actually with a not positive rating, but that's okay. Anyway, the bottom line is that they feel in their markets, I believe they feel or should feel, that they've got enough market share in that market that they don't need to play. They win either way. They already have the newest, latest, greatest emergency rooms in that marketplace. Okay, so that means that they're getting more than their fair share in those markets of the uninsured. So if their hospital isn't in the chosen network and everybody, all of those negative cash flow, they're already paying for the service, goes someplace else because they're not in the network, guess what? They win. They win by losing business that loses them money. And if they decide to be in the network and they get lots of volume, they'll get it not only not at a negative cash flow, they'll get it at a positive cash flow. So it's a double boost. So avoidance of a loss is good. Avoidance of a loss plus profit is great. And that's going to be their very simple calculus in those markets. So don't be surprised if HCA looks like they're not playing ball with the health plans. In some disease states, they may take risk. In other disease states, they may not. The other health plans and the other hospitals, or the hospitals generally, are saying much of the same thing. Where you have scale and share, you will not discount. You do not need to, because somebody else is going to get your problems, and why should you take a negative risk of a negative margin? And so I think that pricing dynamic may be very different than a lot of the managed care analysts think, and different than some of the hospital management think. And then finally, what I also want to say about the managed care plans is, you know, the administration needs the cooperation of the managed care plans to make reform work. The and when, you know, in old conferences, I can remember when Liz Fowler and Dean Rosen were on one of these panels, and Liz Fowler was the sort of Senate Democrat, and Dean Rosen was the Senate Republican, and they were just fresh from the fight of negotiating the Medicare Modernization Act. And one of the things that both of them spoke about was making the government a persistent and consistent business partner. We've lost sight of that in all of our discussions. This is one of the benefits of being old and remembering things way back when. So we've really lost sight of that because the managed care companies have no incentive to trust the government right now. They've participated in Medicare Advantage. They got just absolutely slammed when Medicare Plus Choice rates in BBA 97, instead of rising 8 to 9 or 10%, were cut to rising 2%. Not to say that they're guiltless, because they never are, they're managed care companies. But they were responding to a government whacking of their rates then. They came back in good faith with the Medicare Advantage program, after it was renamed, after the risk corridors were put in, and a lot of other things, and they've made good money. What's good money? 5, 6, 7% operating margins. That's not huge. It's reasonable. There might be some room to share some of that margin with others if they're, if they remember their lessons from kindergarten, but it's still not huge. And then when we come down the line, now you're slamming them on Medicare Advantage. What is their incentive to trust you in the Medicaid expansion or on the exchange? I would argue 0. So we are at a very interesting and tenuous crossroads. Those who have to really defend market share, who believe that they need to be on the exchanges with product, or who are already offering that essential benefit in the market, are likely to participate. But a lot of the other companies that aren't big in the small group and individual market, I don't think they're going to play the first year, and maybe not even the second. So the final thing is the summary of the Wall Street view according to CRT. The hospital stocks have gone up in response to the market finally understanding that health care reform is good for hospitals, because either you lose the uninsured to someone else, or you get paid for the ones you treat. And if something is good, you buy the stocks. I have news for you. It is never simple. It is never easy. There will be winners. There will be losers. There may be more losers than winners, especially for those who discount in exchange for volume and repeat the sins of the past. Right at the time I did this, it was better on hospitals than health plans. As of this morning, I think that's going to change, just because the sentiment beginning from some of the calls I had this morning is beginning to say, you know what, the positive catalysts are done. We got Florida. The stocks didn't react very much. We're not going to get Texas. Therefore, all the news from here is going to be bad, and starvation in the land of plenty will take over. It's not and never was health reform. It's insurance reform. It is still, with all of its problems, the biggest thing to happen since OBRA 87, BBA 97, and Medicare Modernization Act of 03 combined. And the real opportunity here is to reform, is the true reform of the health system, which is transaction by transaction, contact by contact, contract by contract, behavior by behavior, doctor by doctor, patient by patient, system by system. It has never been a system that we could fix with broad brushes. It is hard work. It is meticulous. It is difficult. It is risky. It is almost impossible. And it is crucial that we get it done. I wish all of you success doing it on a day-to-day basis, and thank you for your attention.